Hey, it's the final lesson of Module 2. You made it to ratio, KPIs, and trend analysis. You're probably like, what does that mean? That's literally why I signed up for this course, Daryl. You got to break this down. We're going to begin to figure out how to transform your data into applicable intelligence. So let's just jump right in. All right. So I know some of you all are having flashback to elementary school, middle school. Why do ratios matter? You're probably wondering, like, oh no, I can't do this anymore. I promise you, you can, because this is about your bottom line, and you have to become more financially intelligent about how to navigate this as a leader of your organization, right? So numbers without context, just it's just data. So across my experience, across many sectors, the leaders who don't excel don't just read reports. They actually analyze the patterns. I'm going to say that again. It's the patterns, folks. You have to understand and read the patterns. You don't need to know every detail. You just need to see, hey, I see something is picking up here, right? So you'll be able to master essential financial ratios, KPIs, which means key performance indicators, or review what a trend analysis technique looks like. And then you'll be able to create your own dashboard. So let's jump right in. So the three questions that ratios answer. Number one, in basic terms, are we able to pay these bills, right? And number two, are we using the resources we have wisely? Okay. And then, of course, number three, are we growing sustainably? So, in terms of the current ratio and the current assets, we want to be able to review this formula, which current assets divided by current liabilities. And we have an example here, right? So let's use 500,000 for our current assets and 250,000 for our current liabilities. The current ratio for this is 2.1, but the target that we need to get to be okay is 1.5 to 2.0. And by the way, yeah, so the current ratio is 2.0. Like I got made a mistake there, but you get the point. The target is between 1.5 and 2.0, which means your organization can cover its liabilities, which means this is a healthy situation in this example. So if we look at a quick ratio, which is also what we call an asset test, a more conservative liquidity measure formula would be current assets minus inventory. Then you divide it by the current liabilities, right? So the inventory isn't as quickly convertible to cash, and that's the issue. So if you needed fast cash, you might not be able to sell that inventory immediately, which is why you're not able to use this kind of current formula in this form here, right? So the current ratio is 2.0 in our previous ratio test, and in this more conservative measure, it is actually 1.6. So remember, it's still healthy because it's above the 1.0 line in terms of the target. Okay. So we move on to days cash on hand. This is how you know how long your business will be able to survive. So this is the formula you'll pull out. And again, remember, all of these formulas are in the module. So you don't have to even memorize this, right? But you'll be able to look really quickly. Okay, let me see how much time I have with the cash on hand that I have. So in this perfect example here is 150,000 divided by, in parentheses there, 1.8 million divided by 365 days. All right, you start with the parenthetical with the parentheses here, and then of course you work your way down. In the parentheses, that equals $4,932 per day. And then you divide that by 150,000, which gives you 30 days. That's your survival timeline. So if it's below 30 days, that's concerning for your organization, right? But you're at 30 days, but still, that's not, it's acceptable, right? But you're kind of pushing it. Now, in order to find out your overhead in terms of your business, the formula is in parentheses first, you have your administration plus your fundraising expenses. and then you'll divide that by your total expenses, and then you'll times that by 100. So this is exclusively for nonprofits and ministries in particular, and trying to figure out what your overhead is, right? So for nonprofits, your target needs to be below 25%. And the truth is, a donor who's looking at your nonprofit and looking for a large investment, they want to make sure that you have low overhead. That's vitally important. So, for example, in this example, you have 80,000 is for administrative, 40,000 for fundraising, which makes your total expenses around 600,000. Okay. So your overhead equals, then you use the parentheses. So you start with the parentheses, 80K plus 40K. Start with that first, and then you divide that by 600K times 100, which equals 20%. Now, why does this matter? Again, remember, the target needs to be below 25%. So if it's below, that means you are in a great situation. Okay. So now we move on to the program efficiency formula and ratio here. Again, it's in the packet. You don't need to memorize this, but if you are trying to measure what your mission impact is per dollar, you'll need to use this formula as a nonprofit organization. So your program expenses, you'll divide that by your total expenses and times that by 100. Okay. And then you'll get your answer based on whatever example you use, and you can measure it against the platform measures here. All right. And then we move on to your gross margin formula. You'll use this for businesses. Okay. So you'll start in parentheses, you'll plug in your revenue minus your direct cost. You start with there first, and then you'll divide your revenue by and timesing it by 100. So in our example, we're assuming your revenue was 1 million and the cost of goods sold was 400,000. And then your gross profit would be 600,000. So in this formula, it'd be 600K divided by 1 million, and you times that by 100. You should get a percentage of 60%, which reveals the 60% margin means that after you're paying your direct costs, you have 60 cents from every dollar to cover operating expenses, your growth, your profit, and higher is better. So 40% plus enables your sustainable scaling as a business. So that's the formula you would use to measure your gross margin as a business. Now, for those that are bringing on employees or you have employees, this is how you are going to measure your employees' productivity. Okay. So we have two examples here. So, in example A, you have a revenue of $2 million and you have 20 employees, and the revenue per employee is a $100,000 outcome, right? But in example B, you have 2 million revenue, 40 employees, and the revenue divided by employees is 50,000. All right. So in this example, A is twice as more productive per person. All right. So then you have to compare that to your history. Then you got to compare that to your industry benchmarks and look at your competitors as well, and see how those trends added for you. The next formula that you have here, let me just remind you again, you have these formulas in the module notes and worksheets. All right. So to see if your revenue growth, what your revenue growth rate is, okay? You have an example here. Okay. So you're looking at quarter 1 of 2024 and the revenue is 500,000. But then you see in quarter 1 of 2025, your revenue was 575,000, right? So there's some growth there. So the growth equals, of course, you start with parentheses, this period minus last period, and you subtract that, and then you divide that by 500,000, and then you times that by 100, which gives you the percentage of 15% year over year growth. Okay, and then you'll be able to chart that using a line graph. Now, if this was a course about AI, I'd be giving you some tips and advice on how to prompt AI to actually create a line graph for you. But that's not what we're doing today, and I may offer that in the future. So, of course, what question should you be asking as a leader at this point? All right. Why is growth decelerating? Okay. If it's not this example. Or what is the market saturation? And then the ultimate question is, do we need to adjust our strategy? And that's the bottom line question here. Now we're going to pivot to being able to apply this formula with a nonprofit or a business. Okay. So in our example, we're talking about donors. So we're referring to nonprofits. So the total donors last year was 500, right? So the donors who gave again this year was 400. So the big question is, what's the retention rate? And that's a percentage, right? So you'll do 400 divided by 500, then you multiply that by 100, which gives you 80%. So that means as a nonprofit, you've been able to retain 80% of your donors. Okay. And it costs between 5 to 25 times more to acquire a new customer or a donor than it is to retain one, right? So that means a high retention rate. That means you are at a sustainable growing rate as a nonprofit. If you have a low retention rate, that means you need to figure out a plan to address your retention rate, because that's going to be very important. The next formula that's going to be vitally important for your startup or your organization is how quickly are you burning through your money? All right. We have some examples here, right? So your monthly expenses are about 85,000, and the cash on hand that you have is 510,000. All right. So you'll need to use the formula here. So 510,000, you divide that by 85,000, and that shows you about 6 months. So the question is, will you reach a profitability within 6 months? All right. That's a major question. And if not, when do we need to raise money? Okay. Or capital for your businesses. And then the question is, what can you do to cut down the extended runway there? Because you're burning through cash, depending on what the answer of the example is in your story. And of course, you move on to the debt service coverage. So this formula is looking at the operating income divided by the annual debt payments that you make. So there are two examples here. So you have a comfortable position, which is showing that your operating income is about 150,000, but your debt payments are about 90,000. So your ratio is 1.67, which is basically saying your income is 67% higher than the debt that you have, which means you have a comfortable cushion, right? So that target, again, remember that target ratio? It needs to be above 1.5 to provide that cushion. But in the tight position example here, you have the operating income of 90,000, but you have the debts of 90,000, which means your ratio is 1.0. So you're barely covering the debt, and you really don't have any room for a revenue drop at this point, which means this is unsustainable, the model you are following. Okay. So the big question, why trends matter more than just the single numbers? Okay. You got to study the trends. Okay. So the question is, how do you analyze the trends? All right. So to compare the same period over a year, you have to look at one data point, and that equals another. Okay. Or a dot on a graph. So if you have a series of data points, um, then it'll show you the trajectory through the line. So it's like a line graph. So the line is what's going to tell the story and predict the future. So what are the trends that you need for this analysis? There are just four. All right. And again, the worksheet is in the chat. So the first one is year-over-year comparison. The second one is rolling 12-month average. The third is a pattern break. And the fourth is a 3-month rule. Okay. And an example of this is looking at a trend analysis example here. So we're looking at the first quarter, which is showing us a revenue of 1 million in 2024, quarter one, and it's showing a 5% growth rate. And then you look at quarter two, you went up by 30,000 in the 1 million range. And then it shows you the growth rate of 3%. But then you look at quarter three and quarter four, while the revenue is going up in quarter three, but down in quarter four, you're beginning to see a pattern here. There's a declining growth right? So there's a slowing of the momentum that you're having. And then Q4, it's actually a complete decline. Yeah, there's an investigation that needs to happen whenever you see numbers like this. All right. So the question is there a market saturation? Was there competition that was brought in? Are there some economic factors? Do you need to adjust your strategy before further decline? That's the question here. Okay. So when you're building your dashboard, you have to look at the financial health, the operational efficiency, and strategic progress. All right. We already went through this. Your financial health is using 3 to 5 metrics listed here. Your operational efficiency is using the 2 to 3 metrics here. And then, of course, the strategic process has 2 to 3 strategic metrics. So there's an update of your frequency. So there's daily, weekly, and monthly. So that's what your financial dashboard needs to look like in reviewing this information. So when you're presenting the dashboard to leadership, you need to use traffic light colors. Keep it simple. So visual indicators that communicate status instantly. So green, yellow, and red. Green being on track, yellow being caution, and red is urgent. And then, of course, you need to use arrows that's showing improving stability or the declining arrow, which means it's going in a bad direction. And then the last piece is comparing targets in prior periods, okay? And keeping the context will transform your numbers into clear insights. So, what are the key takeaways on this lesson today? Number one, ratios provide the context that you need that raw numbers simply don't, right? Number two, you got to track that liquidity, the efficacy, and the growth metrics that are needed for your business or nonprofit. Number three, the trends matter more than just the single data point because it's going to tell you something in terms of the direction you need to go into. Number four, the dashboard transforms the data into action. And then, of course, number five, the 3 month pattern requires a strategic response. You did it! Module 2 is complete. So, at this point, you don't have to memorize anything, folks. You have purchased access to the workbook. You have everything you need and it's written down. So, you should be able to master income statements, which is the profit and loss statement. That is uh, able to help you, right? You should be able to look at the balance sheet. And then we've reviewed cash flow statements. You've reviewed financial ratios and key performance indicators. And then lastly, you are now able to read and analyze trends like a pro. You don't have to memorize this because you've got it at your fingertips now. Something that seemed so over your head has now been simplified. I am so proud of each and every one of you for continuing this financial journey of leadership. We have 5 more modules and they'll be rolling out very soon. So check out module 3 through 7 as they come out. And congratulations, you have just completed module 2, interpreting financial reports like a pro.